We're going to be talking about options, which is a very, very interesting aspect of trading. A little complicated. Took me quite a while to really figure out how options work and get somewhat comfortable with them. I've studied them for many years, taken many classes, spent thousands and thousands and thousands of dollars in classes studying options. And it may or may not be for you, but options were created to hedge. They were really created as hedging instruments, and they still continue to do that very well. And so that is one of the main ways that I use them. Now, you can use them instead of buying a stock as well, or selling a stock for that matter. And there's some disadvantages as well as advantages to doing that. Those are spelled out in the manual, so I'm not going to go over all of those. But I do want to be very, very clear on one thing. And in the manual I go a little overboard on it, but again, it's just very important. Anything to do with trading or investing, you need to really understand what you're doing before you do it. Do not put your money at risk until you're fully educated about how the financial instrument that you're investing or trading actually works and the risks involved. So make sure you get fully educated. This is meant just to be a introduction and overview to show you some of the strategies that are available and that can be very effective if, with that qualification, if you really understand what you're doing. So this is not a full-blown options course, but it is hopefully something that can show you how, especially in, well, as I'm recording this, we've just been going through a very, very dramatic bear market. And even if you're getting this course later when we're in a nice bull market, bear markets are going to come back again. They're cyclical, bear, bull, bear, bull. And it really, really does pay to protect your positions. And options are one very good way of doing that if you know what you're doing. So check out some of the links in the manual, go to some of the exchanges, read the disclaimer booklet that's online. That's standard. Your broker, if you open a brokerage account to trade options, your broker is going to require that you read that anyway. But having said all of that, options can be a very powerful tool. They give you tremendous leverage, like futures. And so that's one of the reasons that I mostly trade futures as opposed to stocks. But with futures, you can lose more than you invest. And with options, generally, your losses are limited to your complete investment. So yes, you can lose everything you have. That's bad enough. But worse to lose more than you have invested, right? So it may not sound great to say, well, all you can lose is everything you have. And of course, it's not great. It's horrible. But that's why you have to have very good, stellar money management, allocate your funds correctly, make sure that you're not putting too much money in on any one position. Very, very important. The thing that looks the best to you may not work out at all. Surprises come all the time in the markets. And remember to diversify. The magic of investing comes through long-term diversification. And that's another way to manage your risk very effectively over time. Okay, now, having given all those disclaimers, let's just go ahead and get into it and explain it. And this one video here is really the basics, just to help new people do options understand what they are and some of the basic terminology. And so this is obviously a chart of Microsoft. It's a daily chart. And if we wanted to trade Microsoft, we could do that. And of course, we can go over here, and Microsoft right now is trading at 1966, and it's trying to put in a bottoming pattern here. This may indeed be about bottoming pattern after this long downtrend. Not a bad long here, in fact pretty good one, and for a reversal trade. Now, the question is, so our entry would be here, one tick above the high of that bar, 1 penny. High was 1813, so 1814 would have been our entry. And you could go ahead and just buy however many shares of the stock you wanted to at 1814. Or you could buy an option on the stock. Now, one option contract is equal to 100 shares of stock. So if you wanted to combine the two, you could actually go ahead and buy, say, 100 shares, and then also buy a put. And by buying a put, it would help to protect your long position in the stock. And we'll explain a little bit about how that works. Now, basically, when you go long the market, you are buying the stock, and you are doing that because you believe the market is going to go up. When you short a stock, you are actually hoping that the market is going to go down. And when you short a stock, what you're doing is you're really selling it, but you don't own it yet. So you're selling before you buy, and then you would buy it down here. So it's kind of backwards. Normally you buy first and then you sell later, buy low, sell high. Shorting the stock means you sell first, you sell high, and then hopefully buy low. That's the idea. Now, the corresponding concepts and options to that would be that you're going to either buy a call or buy a put. So either way, you're going to buy. Now, buying a call means that you're expecting the market to go up. So here, if you said, well, I don't want to buy the stock. In fact, what I'm going to do is I'm just going to buy the option, and I think the market's going to go up. What you'd really be doing, to be more proper in your terminology, just to say I'm going to buy an option, doesn't really tell your broker enough information to place that order for you. They don't know what you mean by an option. There's too many different types of options. So what you would say is I want to buy one contract or one call. I want to buy one call. Call means I'm expecting the market to go up. Or if we're here and you think I think the market's going to go down, you would say I want to buy one put. Or obviously you can buy 10 puts, 100 puts, whatever. Either way, you're buying, but to buy a put means I'm expecting the market to go down. To buy a call, I'm expecting the market to go up. That's simple. All right. Now, you can also sell a call, and you can sell a put. So, for example, let's say the market is, well, let's just use that same example. Let's say the market is here. Okay. And there's going to be some dummy out there who sees this and says, oh, I think Microsoft is going to go up. And so that guy or woman will buy a call here. And maybe they're doing it because, you know, Microsoft broke above the 50 MA, whatever, doesn't matter. Some news came out, their, you know, uncle-in-law told them, oh, buy Microsoft here. So anyway, they're going to buy a call. Well, again, there has to be somebody on the other side of that trade, and that could be you. So what you could do is you could sell the call. They want to buy a call, so someone's got to sell it to them. So you could take the opposite side. You sell the call. So when you sell the call, you're actually expecting the market to either go down or just sideways. And in this case, the market did go down, and therefore the joker who bought the call is now losing money, and you're making money. What happens is when they buy that call from you, they're paying you for the call. They're literally buying it. They're giving you money. And you take that money, and that money is now yours. Well, you get to hold on to that money as long as the market, well, there's two things. There's time, because options only last for so long. And we'll show you that here in just a moment. And then, of course, there's also the direction that it moves in. There's interest rates. Dividends are factored into the pricing. A whole bunch of other things. But the most important thing really is which direction the market moves in. Secondarily, timing, how long you have until that option expires. In other words, if this guy bought the option, and this is in January, and he bought a January call, well, that's going to expire normally the third Friday, literally Saturday, of the month. So at that time, the third Friday of the month, which is the last trading day, that option now would be worth nothing. It goes away. It no longer exists. And then if he doesn't cash it in, if he doesn't buy it back, then you keep all the money. You keep the premium, in other words. So, well, he bought already, so he would then have to sell it, actually. So there's two things, though. Number one, it goes down to zero, and the longer the time goes on, the market makes it worth less. So it's not just that Microsoft went down that makes it worth less. It's also that the longer time goes on, the closer it gets to expiration, the less people are willing to pay for it. Why? Because they don't have much time left before that option is going to no longer exist. And that gives them less time to be right about their investment decision. So generally, the more time they have to be right, the more that option is going to be worth, because they're buying time. The less time that they have to be right, the less the option is going to be worth. The market will just not pay as much for it. So you can sell the call to these buyers and collect little premiums. Now the opposite side is also true. Somebody here, let's say they, well, let's take this example right here. Somebody decides to buy a put here because they say, man, Microsoft is just dying. It's dying. It's doing terrible. So I'm going to buy a put. Well, that means they think the market's going to continue to go down. So you could buy a put too if you think the market's going to go down. Or you could say, well, you know what? We've been down for a long time. We've got kind of a bottoming pattern here. This looks pretty good. I think we're going to get a reversal. So you could do two things if you think the market's going to go up. Number one, of course, you could buy a call, which we've already discussed. Or you could take the other side of these put buyers' positions and sell the put to them. So then you would collect the premium. They would pay you for that put. That money goes into your account. And as long as this market goes against them, they're losing money and you're keeping your premium. And then when it finally expires, well, then you get to keep the whole premium. They can sell that put that they bought at any time. So they could sell it and, you know, not lose all their money. But of course, it's going to be worth less, so they will still lose some of their money. But if they wait till expiration, they will lose it all, and you get to keep the entire premium. Okay, so we're going to be talking about all those different factors. We're going to look at 3 different strategies on how to protect your stock positions. And so let's bring up an option chain right now and show you a little bit about how it really looks and what you'll be looking at when you decide to buy or sell an option. Okay. So here's an option chain for Microsoft. And so here's Microsoft. Here's the last price of the stock. There's the bid, ask, etc. Now we go down here. This is our option chain down in this area. Here we have calls. You buy calls if you think the market's going to go up. Here's puts. You buy puts if you think the market's going to go down. Okay, they're separated by the strike price. Okay, what's the strike price? The strike price is the price at which you can, for example, if you buy a call, the strike price is the price at which you can buy the stock. Remember, an option is not really buying the stock. An option is an option. It gives you the option to buy the stock. So you don't really own the stock, you just own an option to buy. It's kind of like buying an option on a house. You put down kind of a down payment. So buying an option on a stock is much cheaper, a lot cheaper. You put down much less money, maybe, a tenth, than having to buy the stock. So, here, for example, let's see, so it's close to $20 right now. So the strike price is here. So if you're going to buy a call, okay, this gives you the right. First of all, you have to choose between several different things. One is the month, the expiration month. Well, it's already February, but it's just the beginning of February right now. It's going to be expiring the third week of February. So you could either, if you want a real short-term option, just hold on to it for a couple of weeks. You could buy the February call, or the March call, or the April, or on and on it goes. There's many other months. So first thing you'll notice, let's just compare the strike prices at 20. There we go. So the strike price is at 20. So you notice the February options are pretty cheap. It's only going to cost you about 45 cents. There's the bid, there's the ask. So we'll use the ask column. So 46 cents you can buy an option. Now actually, because an option, one contract is worth 100 shares of stock, you actually multiply this price times 100. So it would cost you $46. Okay, and the March one would cost you $92, and the April one would cost you $128. And this gives you the right to buy Microsoft at 20. Now, but wouldn't you like the right? Now, Microsoft is already at 20 almost, right? It's at about 1979, 78. So wouldn't you rather buy Microsoft at 16? Sure, I'd rather buy Microsoft at 16 since it's already at almost 20. And you can do that. You can buy the right to buy Microsoft stock for $16 a share right now. You could buy it at $16 a share right now. Buy that option. The problem is that in order to do that, they're going to charge you more for the option. So you see now, again, we'll just circle the ask. So now you're going to have to pay $3.75 for that option, or really $375. If you want to pay for more time, you want more time to be right, you're going to have to pay, and if you want a March option, $385, or $485 if you want the April option. Oops, I'm sorry, actually it's down there. $400 if you want the April option. But then you can turn around and you can go ahead and buy Microsoft at $16 a share and make the spread of. The problem is, believe me, that is not going to work out well for you, because the markets are never going to let you make money that easily. But you can definitely do that. On the other hand, you can say, well, I want the right to buy Microsoft at $22 a share. So, it's already below that. Other people are buying it right now at $19.78. But you want the rate to buy it at 22, but the nice thing is you can do that for only 5 cents. So you can get the option right now to buy it at 22 for only 5 cents or $5. And so they charge you much less for that. Okay, now same with puts. Except everything's going to be upside down because now we're wanting to go short. So here is $20. Now, let's talk about this a little bit. So if we want to hedge a position, what do we want to do? The more that we hedge, the more that it's going to cost us. That's the basic rule, right? So let's go on to the next video, and we'll devote a whole video to showing exactly how to protect yourself, how to protect your stock positions by buying puts.